IAS 23 borrowing cost was introduced to decide whether we should capitalize this standard was introduced to decide whether to capitalize interest cost on the funds being utilized for self-constructing an asset. Earlier, before this standard was introduced, all the costs were expensed off, means were charged to P&L. So some of the accountants were of the view that when we are purchasing something from the market, the seller adds all the costs which they incur, and they also add the interest cost and sell it to us by adding a profit margin. So when we are self-constructing an asset, and if you borrowed specifically, or if you use general funds, so there are some specific funds which you are using, which are borrowed specifically for construction of this asset, and there are some general funds which we have. We borrowed at different rates, like we borrowed at 8%, 9%, 10%, 11%, and from those funds we are using it to make this asset. At what rate we should use it? If we have a specific fund, then the specific rate can be used to capitalize. If we have general borrowings, we can use capitalization rate, that is average rate for capitalization. So the question arises, which assets come under the purview of capitalization? Can we capitalize interest cost to all the assets we are making? So the line which differentiates is all the assets, it says qualifying assets, which takes substantial period of time to get ready for its intended use or sale. When I say sale, that means inventories can also form part of it. Can you give me an example of inventories which may take substantial period of time to get ready for its intended use or sale? And if you borrowed funds specifically for making these inventories, can we capitalize interest cost? Any example for inventory which falls into this category?
Like wine.
So this is the best example we will give. Whiskey, which may take substantial period of time to get ready for its intended use or sale. It may take 12 years of time, 18 years of time of maturity. And if you borrowed specifically for maturing it, for helping it to be ready for sale, we can add the interest cost into the cost of making these inventories. When does it commence? So there are 3 stages to it. Commence capitalization, suspend capitalization, and cease capitalization. We commence capitalization when we start incurring borrowed money is being incurred. On it we can commence capitalization. To suspend capitalization if there is a delay in work. If the delay in work is normal, we can continue capitalization. Normal means we are constructing a dam in Cherrapunji and there is heavy rainfall. If there is 1 month delay in construction of that dam, which is part of the normal process of making a dam in that area, so even though there is no work being done, we will continue to capitalize the interest cost as part of cost of making the asset. We'll cease capitalization when all the work necessary to use the asset or sell the asset is complete. It uses a term when substantially all the work necessary to use the asset or sell the asset is complete. The word substantially means that we are constructing a metro station and the elevator is yet to function, but the stairs are functioning, the metro is working fine. The lift may take some time, or the minor decorative work is yet to be completed. So we'll cease capitalization the moment it is operational, it is ready to function, all the work necessary for it to be operational is complete. We'll cease capitalization. We'll take you through it. So look at the objective and scope, general principle, commencement, suspension, and cessation. These are the three areas we need to be careful about, and that's the area we need to focus on. So it prescribes the accounting treatment for borrowing cost that can be capitalized interest cost as part of cost of making the asset. The standard does not apply to qualifying assets measured at fair value or mass-produced industry or mass-produced inventories. Why so? Why so? It is not eligible for the assets being measured at fair value. When we measure something at fair value, it takes into consideration all the costs, not only the interest cost. It takes into consideration what the market is willing to pay, and the market is willing to pay after adding up all the costs. So if you measure something at fair value, it automatically takes care of all the costs at which someone is willing to sell and someone is willing to buy. So interest costs are automatically inherent in it. Mass-produced inventories do not take substantial period of time to get ready for the intended use of sale. Mass-produced inventories are produced in a short span of time. So they are excluded as part of the scope. So it refers to interest and other costs incurred by an entity in connection with the borrowing cost, which takes and qualifying asset, which takes substantial period of time. So there is no definition for substantial, normally considered more than 1 year. There is no exact definition given by ISB for substantial period of time. It's based on judgment. So qualifying asset can be inventories, manufacturing plants if it is taking more than 1 year time, or they definitely take more than 1 year time to get ready for their intended use of sale. Power generation facilities, intangible assets, internally developed softwares. If you borrowed specifically for them, and if it has reached the relevant stage criteria, then we can capitalize. But if it is in the research phase, we expense of all the expenditure. It's not yet fruitful, so we cannot consider it as a qualifying asset. Investment properties, if we are constructing an investment property for the purpose of capital appreciation or for renting it out to others, we can capitalize the interest cost as part of cost of making this asset. So there is a mandatory requirement that any directly attributable cost of construction, acquisition, or production of a qualifying asset will capitalize as part of cost of asset. Otherwise, we'll expense it off. So not only from IAS 16 perspective, but interest cost also we can capitalize. IAS 16 says that any cost which is necessary for bringing the asset to its present location condition for it to be ready for use or sale. IAS 2 talks about sale, that if it is to be constructed for ready for sale, we'll add all the cost of all the directly attributable cost of construction, acquisition, or production of this qualifying asset are eligible for capitalization. If you borrowed specifically for obtaining a qualifying asset, we have the actual borrowing rate, which is the specific rate. If not, then we'll use a capitalized rate on the expenditure incurred. Capitalized rate is the weighted average cost of borrowing. We'll take a general rate, average rate. If you're borrowed at different rates, 8%, 9%, 10%, we'll see what is the total cost of borrowing, what is the total money borrowed, what is the average rate applicable to us. We'll use that weighted average cost of capital. Now you need to do this and let me know what should be the cost which should include as part of borrowing cost. So I'll leave it to you. So here's an entity on 1st January, Alpha contracted for the construction of a building for 2,000 on land that it had previously purchased. The building was completed at the end of December 15, and during the period, the following payments were made to the contractor. So if you notice here, 200 were made at the beginning of the year, 600 were made after 3 months, 1,000 was made after 9 months, and 200 in the end. That is on the last day. The total money is spent on different dates. So we'll take the average money being used on the project. Now there is a 10-year, 4-year note which is specifically borrowed for this project, and debt outstanding on this is 700. So we can use 700 at the rate of 10% specifically borrowed for this fund out of the total average money which we're using on this project. The remaining money we'll use capitalized rate like 12.5 and 10%. Average of these two rates will be using to capitalize. 12.5% and 10% are two different funds being used. So what is the total cost of both the funds? We'll take the average of the two and we'll charge that rate for the funds being used on this project. So 200 were used for 12 months, that is at the beginning of the year. 600 was used for 9 months. 1000 was used for 3 months, and 200 was paid on the last day. So there is no interest cost for this 200 which is paid on the last day. The total average money which we use on this project is 900. So out of 900, 700 we know is specifically borrowed. So we can charge 10% for specifically borrowed funds of 700 which we have used from our own funding which is specifically borrowed. The 200 we have used from the funds which are borrowed at the rate of 12.5 and 10%. So average of 12.5 and 10% turns out to be 11%. So we charged only 11% for the general loan we borrowed at the rate of 11% on the 200 fund being used on this project. In total 900, 700 borrowed specifically, 200 borrowed from the average fund or from the general fund. So we use the average rate applicable to it, 11%. So the average rate is calculated like this, that if you borrowed 12.5% rate and we borrowed 1000, what will be the cost of interest for the year for 1000 borrowed money at the rate of 12.5%? If you borrowed 1500, what is the interest cost at the rate of 10% for the year? So total funds borrowed are 2500, 1000 at the rate of 12.5 and 10% at the rate of 1500. So total interest cost for the year will be 125 and 150 respectively for these two borrowings, A and B. And the total interest cost for the year is 275 and the total borrowed funds is 2500. What is the average capitalization rate? It is 275 interest cost in comparison to total. 275 is the total cost, interest cost of all the borrowings we have, and 2500 is the total borrowing of all the funds we have. What is the average cost related to it? That is 11%. 275 in comparison to 2500 is 11% of the total borrowings we had. So 11% is the capitalization rate which we can use. Emma, is this clear?
Yes, I got it, Amit.
Okay, thank you.
So borrowing costs are always calculated on the basis of weighted average for how many months?
If there are many borrowings, if we have different borrowings and we use those general funds, then we calculate the capitalization rate. If we have a specific rate, like we had a specific rate of 10%, borrowed 700. And not only this, we'll also use the borrowing only which has been incurred on the project. We'll not charge all the borrowing money interest cost into the cost of capitalizing this asset. We may have borrowed for different purposes. So we'll not add it to the cost of making this asset. On this asset, we used only 200. So we will capitalize only in relation to 200 for this project. 200 we use for 12 months. 600 we use for 9 months. Okay. 1000 we use for 3 months. 200 we use on the last day. So whatever money we are using on this project, only that is eligible for capitalization, not all the borrowing cost. We cannot use this loophole that since we are allowed to capitalize all the costs, whatever funds we have borrowed will add up into the cost of making this asset. No, we cannot. Only the funds which are being incurred and used on this project.
Okay, in the similar example, in case of B, that is also, for example, is used specifically for the project. For example, the 1001 for at the rate of 12% is also used specifically for project, and the last one was 10%, which wasn't mentioned for any project. So we would have used 700 first at the rate of 10%.
In that case, if we have two borrowings for specifically for the project, then again we'll have to take capitalization rate
of both of them.
Yeah.
The average of both of them.
Average of both of them. Another thing is that if you temporarily invest, suppose you borrowed 700 temporarily. You have borrowed 700, but you do not need this. You need this out of 700. You used only 200 if you noticed on 1st January.
Yeah.
And then you needed 600 on 31st March. So you can temporarily invest this for 3 months out of 700. 200 you used on day 1.
Yeah.
You may also do so that 500 you invest temporarily.
Mm-hmm.
If you've invested 500 temporarily because you'll need it on 31st March, you'll get your money back.
Yeah.
Out of 700, 200 you've used, but 500 is idle with you.
Yeah. Yeah.
You also have a choice. money management that you can invest it temporarily. And if you invest it temporarily, if you get some interest income because of investing it temporarily, that will also reduce your borrowing cost. 900 will get reduced by that cost. For the total interest expense, sorry, total funds are 900. Total interest expense is 92, which is eligible for capitalization. This 92 will also reduce by 500 invested temporarily for 3 months. Any investment income you get because of temporary investment reduces your borrowing cost eligible for capitalization.
So we will assume the same rate of that 10%.
Not necessarily. Not necessarily. You may be able to reinvest it at the rate of 9 or 8.
That will be mentioned in the question.
That will be mentioned. That will be mentioned.
So that will basically reduce my cost to 500 probably if it is 8%, minus 500 and 8%.
8% of 500 for 3 months is 8% of 500, 40 for 3 months will be, you can, so you can reduce your total capitalization borrowing from 92 minus 10. 82 will be eligible for capitalization.
Okay.
So if we temporarily invest, I'm just assuming it, if we temporarily invest our specific borrowings 500 for 3 months and we get a rate of 8%, we'll get 40 investment income per year. So for 3 months, it is 40 into 3 by 12. 10. So total borrowing cost of 92, total borrowing cost of 92 will reduce by 10, and the amount eligible for capitalization is 82 in that scenario. Clear?
Yeah. Amit, if you go to the same example, just wanted to clarify, as I asked the same question, if the second scenario, a 12.5% of 1,000 shares is also used for the project. So we'll be taking the average of 1,000 at the rate of 12% and 700 at the rate of 10%, correct?
So first question first. Your question was if you have two funds which are specifically borrowed.
Yeah.
So we'll take the average of those specific rates.
Okay.
But apart from this, if we need general borrowings also to invest into it, then the general borrowing rate will be the capitalization rate. We cannot mix up.
Okay. Okay.
Okay. So for 700, we'll use the specific borrowing average rate, and for general borrowing of 200, we'll use general borrowing average rate. Now, if you have borrowed specifically, if you have two funds, definitely you'll not need 12.5% fund and 10% fund. You'll be sufficiently well able to manage the two funds which you borrowed specifically will be enough for incurring the cost or whatever you require to construct, I guess. Okay.
So Amit, my one question is that, so like this particular thing, like if we use this FIFO method, like we use 700, which is a specific borrowing used for 1st January and then 31st March, and balance we calculate. So is it something that we have to follow this strict rule that first of all, we have to get the average months used? What is the average weighted period the construction cost has been put into, and then we have to calculate the capitalization on this in this particular example? Do we have to follow this strictly?
Yes, we'll have to follow the hierarchy that first we'll use specific funds.
Okay.
If you consume the specific funds, then we can use definitely from where you got the money. If you had only 700 borrowed in your pocket and you have used all the money, from where did you get your 200 extra which you have used?
Yeah.
You got this 200 extra from your general borrowings.
Right.
So we'll apply the general rate now. Okay.
Yeah. So if I say 1st of January we used $200 out of the first borrowing, which was 700. So we use that.
Apply the specific rate.
Okay. So we don't have to do any permutation combination. Like first of all, we will use the 700 and then we'll go by the general borrowing. Okay.
No. We could have done it directly as well. You could have applied 200 into specific rate 10%. It would have been 20.
Yeah.
Then 600 into 10% into 9 by 12. 1000 into 3 by 12 into 10%.
Right. Right.
So what I did, I took the average first and then applied the one rate to it. So mathematics is a choice. The biggest problem with accounting is that we confuse it with mathematics.
Yeah, because I did a calculation, I got 105. So I think I need to recheck
So
that.
mathematics, I leave it to you. Mathematics is always a choice. So there are two areas which we can avoid doubts into our learning of IFRS. One is, am I emotional in asking this question or is it really a technical question? One. Second, am I confusing mathematics with accounting? Okay. Accounting is simply debit and credit. What will be recorded as an asset, expense, income, equity. How we arrive at that calculation is mathematics. And mathematics have different ways of arriving at the same situation. Okay. So if mathematics is wrong, do not say that my accounting principles are not correct. There's a thin line between the two. Okay, clear? So go to the root of the problem, whether it is mathematical calculation which is bothering me or whether it is accounting principle which is bothering me. I think this gives a lot of clarity where I should focus. Commencement of capitalization, when the expenditure for the assets are being incurred, you started spending the borrowed money and you started constructing. Borrowing costs are being incurred, activities necessary to prepare asset for its intended use or sale are in progress. If you started incurring money on it, you can commence capitalization. Cease capitalization when all the activities necessary to prepare the asset for its intended use or sale are complete. Sometimes qualifying asset is completed in parts and each part can be used separately. Then capitalization of borrowing costs should cease when all the activities to prepare that part for its intended use or sale are completed. Like we are making 150 flats, and if 100 flats are complete, we'll cease capitalization for 100 flats. Will continue to capitalize for the 50 flats remaining which is pending. And I took the metro example as well. When substantially all the work is complete, you'll cease capitalization. Suspend capitalization during the extended periods in which active development is interrupted. There is delay in work, there is some strike, there is some fire, there is some abnormal activity which is not part of the normal process. You suspend capitalization. If it delay is part of the process and when substantial technical and administrative work is being carried out, if that delay is part of the process, like the Cherrapunji example, if the rain is part of the process of constructing a dam there, will continue to capitalize, or if the delay is because of substantial technical and administrative work which is going to enhance the capacity of that asset, or it is necessary for that asset to function, then we can continue capitalization or suspend it. So disclose the accounting policy adopted for borrowing cost, whether we are using a specific rate, borrowing rate, when we commence capitalization, when we suspend it, when we cease capitalization, amount of borrowing and capitalization rate used, we need to disclose. This is all for the standard on borrowing cost.